Hey, good morning, everyone. Marty Mazzora here. This is the 5th of April, 2023, Wednesday, with your midweek market snapshot. And clients, this will be the morning message as well. It's a little after 7 o'clock a.m. Pacific time, 10 o'clock, obviously, Eastern time. Market's been open for a little more than a half hour, and I wanted to wait for the ISM Services survey results for March to come out before I started talking at you this morning, because I'm just kind of seeing some interesting, maybe a shift in terms of what's moving markets on at least a short-term basis. And I wanted to look for maybe a little confirmation of that today. And I think maybe we got a little bit of that confirmation. And again, this is just momentary stuff, just kind of looking at the intraday movements, seeing interesting dynamics in some of our short-term sentiment indicators and so on. And what I'm getting at is that, bad news has been good news for the market pretty consistently for quite some time. And what I mean by that, when we got data that suggested the Fed is maybe going to back off, then markets would rally, right? And I've talked about this and I've written about it ad nauseum. I think I kind of hint to it almost every morning. I did this week where I said, we get weak data or sour data is kind of makes for sweet Fed policy, and the market likes that. But what the market is getting wrong is if Fed fund futures are right, then we get 3 rate cuts by the end of this year. Those aren't going to happen at an S&P that's trading around 4,100. I can say that one with a great deal of conviction. Now, people tell me, or I hear people say, hey, the Fed doesn't care about the stock market. And my reply would be, really? Just watch a press conference with Jerome Powell and watch his physical reaction. Just watch him when they ask a question about the stock market, like a few meetings ago, when the gentleman incorrectly said that stocks are up 2% on your commentary, and he misread his phone, and it was maybe 1 or 2%, and stocks were actually down by that much. And Powell just absolutely stammered, and he gave a statement that ultimately had stocks roll over, because the guy said stocks are up, they were actually down, and we had a rough day that day. But clearly that question had Jerome Powell thinking. And it's the opposite. When the market looks really weak or looks somewhat tenuous, his instinct is to say things that kind of sweeten it up a little bit. Having been in this business for 38 years and watched the Fed very closely, Alan Greenspan in particular was uniquely concerned about the stock market. And it makes sense because they are concerned about the wealth effect. And rising stock prices tend to engender good feelings and people go out to dinner, right? Falling stock prices, the opposite, okay? Well, they're between a rock and a hard place, right? Because inflation is still a huge concern and they've promised to get it back to 2%. So if they think about the market and they want to continue to keep animal spirits alive, or they're afraid anytime animal spirits are about to contract and they say things, well, it doesn't help the inflation fight. So really, really tough position they're in. I wouldn't want to be them. So here's what I'm getting at this morning, though. The ISM survey results came in really soft. In fact, let me just summarize a few things for you from the report. In fact, I'm just going to go to where they look at results at a glance. Okay, so the Services Purchasing Managers Index or survey is still growing, but it's growing at a slower pace, and it came in under expectations at just 51.2. Above 50 still says we're expanding. Manufacturing was down at 46 something on Monday, and that's like the 4th month in a row, I think, or maybe the 5th. Manufacturing is in a recession already. Services is still holding up, but we're contracting in terms of the rate of growth. Business activity is growing at a slower pace. New orders are still growing at a slower pace. Employment is growing, but at a slower pace. Supply deliveries are actually faster, right? So they're getting things there faster. Inventories are growing at a faster pace. That's not a positive sign about the economy. Prices are still increasing, but at a slower pace. Backlog of orders are actually contracting from growing. So they've actually slipped into contraction mode, backlogs. New export orders are contracting from growing. Imports are contracting from growing. Inventory sentiment is too high, and it's getting that way faster. Folks, that should just be absolute party for the stock market, the way it's been trading up till now. Well, as we were waiting for this to come out, the S&P was down about 8 basis points. As I speak at you, it's down 29 basis points. It's not a big decline, don't get me wrong, but it's interesting that it's not rallying. Loretta Mester was out this morning, a Fed president, said, we didn't say we're going to hike next month. Said we don't know yet. I thought that was pretty dovish or pretty bullish. Now, as I've expressed, tech stocks, right? And I'm going to talk about the NASDAQ 100. They're very long duration and therefore very interest rate sensitive. So, tech's been rallying hard this year on that bad news is good news stuff, right? Well, the Qs, the NASDAQ 100 index, is down 82 basis points as I speak. Now, you know what I've been preaching lately? That's not probably the right narrative right here. That at first blush, weak data should be good for tech. At second blush, if it's really to the weak to the point where the Fed's going to be cutting rates the second half of the year, that's a recession. And a recession is not going to be good for tech stocks under any circumstances, okay? Particularly when they're up 20% year to date. So again, I don't know what tomorrow looks like. Clients, you know how we approach this. We think stocks at a level higher than general conditions dictate, particularly when we look at projected earnings. So stocks will come down to where conditions dictate they be, or conditions are going to have to come up to where stock prices dictate they be, or we meet somewhere in the middle. What does that mean to me? It just means the risk-reward setup isn't great right here. Are we exposed? Sure we are. We need to be. We could absolutely be, I don't want to even say right or wrong. I think we're right that the risk-reward setup is precarious right here. If we're saying that the market's going to roll over, then we could be wrong. But are we really saying that? No, we're just saying that the risk of the market rolling over is there. So clients, on the morning notes, I usually give you, the number of core positions that are up and down. Most of them are down today. But the good news is that the things that we've rotated to and added to lately, like healthcare and staples, away from things like materials and miners and industrials, right? Those are our best ideas once we get through this bear market. But we see some weakness, and we saw some weakness ahead, right? So we needed to cut that and get a little more defensive. Healthcare is actually up 1.15% right now, and staples are actually up 0.2%. The other things that are working for us, Johnson & Johnson is a new position. It's up 3.3%. Dutch Bros, incredibly, is up 2%. That's a surprise to me. Treasury bonds, which we've been adding to, is up almost 1%. Long-term treasuries are. Ag futures, which is one of our long-term best positions we added about 2 years ago, and that's been a really good run for us, is up 0.5%. Intermediate-term treasuries up 0.5%. AT&T is up 15 basis points. Emerging market debt in local currency terms is up 14 basis points. Gold is hanging in there. We're going to look at the gold chart, and then Vietnam equities. And those are the only things that are up. But we're only down 19 bips on the core. S&P is down now 28 basis points, and the NASDAQ is down about 80 basis points. The losers, Albemarle, the U.S. lithium miner that we like, it's getting walloped this morning, down 7%. MP Materials in that same kind of space. It's a rare earth miner, is down 3.5%. AMD chip maker, which you think would be rallying, it's had an incredible run this year, is down 2.7%. Uranium miners down 2.5%. Base metals miners, which we cut in half recently, down 1.27%. Folks, those are actually areas that the next bull market, I think, is going to be very friendly to. But we have to be careful in terms of sizing those things, right? So even though just a handful that I mentioned of our core positions are up, those are positions that we have good size in. And therefore, right now we're down 17 bips. S&P is down 25 bips. That's not much. And the Qs, the NASDAQ, is still down quite a bit. So again, folks, and again, we have days where the market's up and we're down. So we're not stock market investors. We're global macro investors. And therefore, we have a lot of alternative exposure in there, as some of the things I just mentioned. Okay, so let's look at the technicals. We've got the S&P 500 daily chart there in front of you. And that bull flag played out about as good as you could ever ask for, right? I remember, we drew these, this uptrend line, just a classic textbook bull flag. The flagpole becomes the target, right on the screws, and then it rolled over, right? In here, folks, if we take this level right in here, and we go from there to there, it's a bearish divergence on the MACD, but I actually read this as bullish in here and confirming that flag with this buy signal, and we still had a positive divergence, almost to overbought territory on the RSI. Now, on the hourly chart, however, we were getting a clue here amid that bullishness on the daily that things were going to roll over, right? So you had just a perfect rising wedge pattern. You had divergences forming, hugely overbought on the RSI, and you can see we're breaking down out of there today. And of course, we could go ramping right back up. Some Fed chairman could say, hey, we're going to cut rates. I don't expect that right now, or Fed governor. But anyway, some news could come in that would be bullish, but I don't know right now if more scary news about the economy would actually be bullish. I'm beginning to wonder if we're not turning the corner where bad news is bad news, and that's ultimately where we think we get that'll have us getting down to hitting our lower targets down in here. I did paint a gap right there, and if we're right and we're in a bear market, let me do that better, that gap gets filled in the not too distant future, and that would get us back below 4,000, so we'll see how that plays out. Now, I've been focusing a lot on the QQQ, which is the ETF that tracks the NASDAQ 100 index. This just happens to be the daily chart because I have it up. Looks a lot like the S&P chart, rising wedge pattern, bearish divergences, way overbought, sell signal. But I remember I've been saying that the daily is the one that's concerning me on behalf of the broader market. And I think I said that the problem for the S&P is actually the NASDAQ and the concentration that we talked about. So this is a pattern we've been tracking, right? There's your rising wedge pattern. And and we do that again. There's your rising wedge pattern, and that is just about as bearish a chart as you are going to find. And if this thing rolls over and we get our sell signal, if that were to happen today with this decline, and we break through the uptrend line, that's really where short-term traders would begin to short. If they look at technicals the way we do, right? Coming right off of overbought levels, and when we've been here before, this one right in here in particular, almost overbought with your rising wedge pattern, right? That's quite the decline to the bear market lows, right? And then of course, here we were, right? Buy signals, this and that. We were looking at this back then, and we've had a very, very nice run since then. Okay, so right now, looks pretty precarious. This market can do anything, right? I'm not telling you what's going to happen. I'm just telling you what odds favor at this moment in time. We've been looking at Apple and Microsoft, two biggest positions in these indexes, so I'll just keep doing it here for a while. You get your rising wedge pattern. We'll just look at the dailies just in the interest of time. Okay, just looks like what I'm showing you in the Qs. Microsoft. Just same kind of stuff. So these are just, these are patterns that say, momentum is dying. You're at a new high. This turns into a failed breakout. You're in really bad shape. I'll say it again, though. The bulls could say, I'm out of my mind. This is a breakout. This is a test of that now support. You break above here, which we actually have broken above, my original rising wedge, right? And we're testing that. So, hey, I get it. You may be right, but I think we're in a bear market. And I think this ultimately fails. And I've been wrong before. So we'll see. I also have been pretty bearish short term on gold, and there's where I've been wrong, right? So I've showed you the rising wedge. I said, sure enough, we broke below that right here. But look what we're doing. We are making a new high. However, we're still making that against some pretty bearish divergences. Now, you can be really bullish on gold. Frankly, we are bullish in a pretty big way on gold longer term. It's one of our biggest positions, and I'm not changing that. I'm just telling clients that, technically right now, gold's in kind of a tough spot. Now, the fact that gold is up, it's only up 4 basis points today. On the prospects for weaker data, that makes sense, the way gold's been trading. A lot of people think of gold as an inflation hedge. It can be. It trades on different things at different times. The dollar is starting to go up a little bit. I'm going to finish with the dollar index, and that's consistent with our latest technical assessment of the dollar. And that could be a little bit of a weight on gold, but gold's really trading long term, I think, going forward on the prospects for real interest rates. And if the world shapes up the way I think it almost has to with the debt to GDP ratio in the US, is that we're going to live in a world for quite some time to come after we get through whatever this bear market has left, of potentially negative real interest rates where inflation is actually higher than nominal interest rates. And that is just a wonderful recipe for gold over the long run. And not to mention the fact that central banks, for reasons we can get into later, what moves the U.S. has made here of late, has inspired central banks to buy even more gold as a reserve currency. So that's not the biggest part of our thesis, but that's one that a lot of people are talking about. I've been also focusing on a bullish pattern for DBA, which is our ag ETF that is another not small position for us. And that looked really, really bullish to me. We looked at that right there on that candle. We've had quite the breakout since then. It was consistent. We have a buy signal right there. We had a bullish divergence on the RSI, so that's played out pretty well technically, but you can see it's beginning to roll over. So if I want to continue to be bullish, I can say, that could turn out to be a nice bull flag pattern if we can continue to get some consolidation, particularly right about that 200-day moving average if we bounce off of that. I will say that, however, that this is not quite there, but if this gets to this level and the MACD is not confirming it, which is look what would happen, suddenly the short-term chart on our ag ETF would not look so good. It would look like a lot like the gold chart. In here, it looked like the opposite of that. So we'll see how that plays out. And then lastly, readers of the blog, Monday I featured the latest results of our monthly scoring of our own equity market conditions index, and it's -50, and that's a really low reading that says conditions aren't so good. And I talked about the dollar, and I showed you a chart. We came in to the month of March with a neutral technical look at the dollar is how I couched it. But by the time we got to March 10th, suddenly we were bearish. We had a recent high. We were testing this level in here, and our momentum indicators were beginning to roll over. So the dollar rolled over. And what happened to the stock market? The stock market went up. The stock market lately, for sure, has been negatively correlated to the dollar. Okay. Remember how bad February was for stocks? Well, look how good it was for the dollar. Okay. So right now, what do we have? We have a declining wedge pattern with bullish divergences. So my point, we're actually bearish on a long-term trend basis, the dollar. But what I said is right now, for the next few days, perhaps weeks, the dollar has a pretty bullish setup. And that could be a headwind for stocks. And the dollar has just continued to go down this week, although today it's actually up a little bit as stocks are down a little bit. Just looking at the S&P, NASDAQ is down more than that. And then it looks like in a couple of corners, sentiment is really beginning to pick up. Now, bullish sentiment, from a contrarian perspective, and it seems to work pretty well at the extremes, is a negative for the market. So perhaps feeding this scenario right here, and maybe why bad news is because bullishness has been really ramping up. I'll say it again in a few corners. So maybe some of this data is having them rethink their narrative if the bullishness was predicated upon, hey, there's not going to be a recession, this year. And I'm getting some pushback from people I know that the recession isn't going to happen. Our data as every day goes by, says, oh no, recession is highly likely on the relatively near-term horizon. And that's the thesis for why we think the bear market, probabilities, I should say, for the bear market to see another leg lower are high enough to have us to continuing hedging, continuing to get a little defensive, in our sector allocation, as I just explained, and just kind of waiting for a better opportunity or waiting for conditions to get to the point or get in line with equity market valuations and what earnings projections we think should be before we take on more risk and prepare more aggressively for the next bull market. So I think caution is warranted right here. And I'll say it over and over again. After 38 years, I've been humbled too many times to say that I know anything is going to happen. But the more humble I've become and our team has become, the harder we work at the data, at all of the things that we look at to determine the risk-reward setup, not make predictions about direction, but about risk-reward, and act accordingly on behalf of our clients. Anybody who's not a client who's watching this, I am unequivocally not giving you investment advice. You're watching it because maybe it gives you some insight from just one professional who's been doing this a long time. Your decisions are going to be your own, based on your own research, based on your work with your own advisors, and I wish you all the luck in the world. Thank you for watching and listening. Hope you have a great rest of the day. Should come at you with a message in the morning, and then with the long weekend, we'll be pretty quiet on the blog, probably. It may be that Monday morning's note is where I share with you the results of our weekly economic analysis. Happy Easter to all of you. Hope you have a great weekend again. Talk to you soon. Bye-bye.